Your house is on fire. Not a cute little kitchen fire. Not a maybe call the neighbors fire. I mean the kind of fire that makes your chest tighten before the smoke even reaches you. The kind where the walls feel alive. The kind where your brain stops being philosophical and starts negotiating with God. You are coughing. The exits are blocked. The air is getting thinner by the second. And in that exact moment, someone offers you a golden fire extinguisher. It is insanely expensive. It looks overpriced. It feels overpriced. Under normal circumstances, you would laugh in their face. But these are not normal circumstances. When your house is burning down, you do not open Excel. You do not compare valuation multiples. You do not say,
Let me wait for a better entry.
You buy survival first. You complain about price later. That golden fire extinguisher is gold. And this is where the joke turns cruel. The moment you finally buy it, it does not calm you down. It does not put out the fire. It does not wrap you in peace and whisper, "Good choice, champ." Instead, it starts whipping up and down in price, like it is having its own nervous breakdown. Up, down, up again, down harder. So now you are not just trapped inside a burning house. Now you are trapped inside a burning house, holding the most expensive emergency tool of your life. And it cannot decide whether it wants to save you or emotionally ruin you first. Welcome to the sovereign game of gold. This is the part retail always gets backwards. People are taught a very simple bedtime story. When the world gets scary, gold goes up. War, gold up. Inflation, gold up. Financial panic, gold up. Roll credits, buy the shiny rock. It sounds logical because it is logical, just not complete. Because in a real liquidity crisis, gold is not just a safe haven. It is also one of the last good things left to sell. That is the trap. Look at what happens when markets start bleeding. Stocks fall. Then they fall more. Then the people who posted long-term conviction quotes 2 weeks ago start refreshing their portfolio every 7 minutes like screen brightness can change macro policy. They wake up at 2:13 a.m., check futures in the dark, convince themselves it is just noise. Then check gold. Then check the dollar. Then check gold again. As if betrayal becomes less painful on the third refresh. Trading screens turn red. Volatility spikes. Risk models tighten. Funds deleverage. And brokers start sending those very polite, but spiritually violent messages known as margin calls. A margin call is just Wall Street's professional way of saying,
"Hello, your account is dying. Please send cash immediately, or we will begin selling your belongings on your behalf. Best regards."
That is all it means. It is not philosophy. It is not macro poetry. It is a debt collector kicking your front door at 3 a.m. while your portfolio hides under the bed, pretending not to be home. Now here is the 5-year-old explanation. When panic hits, investors do not sell the thing they hate most. They sell the thing they still can sell. That is the whole game. If your stocks are down 30%, selling them feels like swallowing broken glass. If your speculative trash is already dead, there may not even be a decent bid left. But gold? Gold still has buyers. Gold still has a bid. Gold still looks respectable. Gold can still become cash quickly. So what happens? The exact asset people bought for protection becomes the asset they are forced to dump to save everything else. Not because they stop believing in gold. Because the broker does not accept, "Bro, just zoom out," as collateral. This is why gold behaves so strangely in the middle of chaos. Retail expects a rocket. What they get is a washing machine. Price goes sideways. It jerks around. It teases a breakout, pulls people in, then snaps back down and kicks them in the teeth. It prints nasty upper wicks that make breakout buyers feel smart for 8 minutes. Then it drops just hard enough to make them question their intelligence, their timing, and, in some cases, their entire bloodline. It is not just sideways. It is sideways with a knife. And that is what hurts retail most. A clean crash at least feels honest. Sideways torture feels personal. Because it does not just attack your capital. It attacks your confidence. It makes you second-guess good ideas. It makes you stare at 15-minute candles like they are a medical diagnosis. It makes you say things like,
"If it just bounces one more time, I'll reduce a little."
which is investor language for, "I am no longer in control of my life." Think of it like a giant centrifuge. All the small investors are tiny drops of water stuck to the spinning walls. The machine starts turning faster and faster. News gets worse. Stocks get weaker. Fear gets louder. Gold teases a breakout, then reverses. Teases another one, then reverses again. Everybody gets dizzy. Everybody loses patience. Everybody starts letting go. And right in the calm center of that spinning machine are the players with real balance sheets. Central banks, sovereign funds, bullion desks, long-duration institutions. They are not checking charts in the bathroom. They are not panic selling gold to cover rent on bad tech stocks. They are not getting margin called into an existential crisis before breakfast. They are standing in the middle while the machine shakes everybody else off. This is the part people love to dramatize as some cartoon conspiracy. It is actually worse than that. Because it does not need to be a conspiracy. Nobody has to press a secret red button. Nobody has to gather in a dark room and laugh at retail. The structure of the market already does the dirty work. If you are leveraged, time becomes your enemy. If you need cash now, conviction becomes decoration. If your portfolio is on life support, you sell whatever still has blood in it. And gold usually still has blood in it. So while retail is standing inside the burning house, half choking on smoke and half choking on price action, the bigger buyers are effectively parked outside with trucks, waiting for desperate people to throw valuables out the window. That is what a liquidity trap looks like. It does not feel like a trap at first. It feels like protection. That is why it works. You think you bought a shield. What you actually bought was a countdown clock. Because a crisis does not reward the person with the best narrative right away. It rewards the person who can survive the longest. The market does not care whether your thesis is clever. It does not care whether your macro thread had 47 reposts. It cares whether your balance sheet can stay alive long enough for the thesis to matter. That is why gold does not always save retail on impact. First, it tests them. Then it exhausts them. Then it transfers from weak hands to strong ones. And only after enough people have sold the safe haven to meet margin, plug losses, and stop the psychological bleeding, only then does gold finally get room to breathe. That is the sovereign game. Not everyone gets to keep the lifeboat. Some people are only there to hand it over. If you think this sounds cynical, good. If you think I am exaggerating, even better. Because that usually means you are standing in the same emotional place most investors stand right before reality introduces itself with a folding chair. So let's go back to 2008. Back to the year when the global financial system looked like a clown car on fire, rolling downhill, while the people inside were still arguing over whether the airbags were priced in. Lehman Brothers collapsed. Banks stopped trusting each other. Credit markets froze. The whole system started wheezing like a lifelong smoker trying to sprint up a staircase. And when the world starts sounding like that, human beings do what human beings have always done. They run toward whatever feels old, heavy, and harder to print than government promises. They run to gold. Because that is the bedtime story. Crisis comes. Gold saves you. The end. Nice story. Comforting story. Also the kind of story that can get your face dragged across the pavement if you enter it with leverage and no emotional stamina. Because when we look at what actually happened in 2008, the fairy tale gets uglier. Between March and October of that year, the financial system was not just under pressure, it was going into cardiac arrest. And what did gold do during one of the worst financial panics in modern history? Did it explode upward like some holy metal elevator to safety? Did it wrap retail investors in a magical golden blanket and whisper,
"Relax, sweetheart. Macro is working"?
No. It got hit hard. Gold fell almost 30%. Read that slowly, like your net worth is attached to the sentence. The so-called ultimate safe haven lost nearly a third of its value during the exact kind of disaster people buy it for. And that is the part that destroys people mentally. Because losing money on a risky asset feels bad. But losing money on the thing you bought to protect yourself, that feels insulting. That feels personal. That feels like paying extra for a parachute, and then discovering it has chosen this exact moment to explore volatility. Retail investors lost their minds. They panicked. They complained. They called gold a scam. They stared at the chart like it had betrayed them in public. Some of them sold in disgust. Some sold in fear. Some sold because they told themselves they would wait for the bounce, then watch the bounce never arrive on their schedule. Not because the long-term thesis was wrong, because the path was too painful. And this is where the 5-year-old explanation matters. Imagine everyone in town runs into the same storm shelter because a tornado is coming. That part makes sense. But then, while they are hiding inside, a second problem shows up. The roof of their house is collapsing. The bank is pounding on the door. The bills are stacking up. Their other investments are bleeding. And suddenly they need cash right now. So, what do? They start tearing pieces off the shelter and selling them for money. The shelter was not fake. The tornado was real. They were just too broke to stay protected. That was gold in 2008. Gold was not broken. People were. Leverage was the killer. Margin calls were the butcher. And time was the getaway driver. Funds, banks, and overconfident investors had stuffed themselves with garbage assets and borrowed money. Then the market turned around, looked them dead in the eye, and said,
"Huge! Pay me now!"
And when that happens, investors do not sell the thing they hate most. They sell the thing they still can sell. That is the rule. Toxic mortgage paper. Nobody wanted it. Broken real estate bets? Good luck. Over-engineered structured nonsense? Dead on arrival. But gold? Gold still had buyers. Gold still had a bid. Gold still looked respectable. Gold was still accepted by the global pawn shop. So they sold the shiny rock. They sold the lifeboat to make another payment on the Titanic. That is how insane liquidity crises become. They do not just destroy bad assets. They force people to liquidate good ones. And this is where retail usually confuses price with truth. They see gold falling and assume the thesis is dead. They see red candles and assume the story was fake. They start saying things like, well, if gold is down too, then what is even the point? That sentence has destroyed more portfolios than bad analysis. Because the point of a safe haven is not that it never gets sold. The point is what happens after the forced selling ends. And that is the part weak balance sheets never get to see. Once enough desperate holders puked up their protection. Once enough exhausted people confused temporary pain with permanent failure. Once enough accounts were forced to sell whatever still had blood in it. Then the transfer happened. The stronger balance sheets stepped in. Institutions with patience. Sovereigns with size. Serious money that did not need to sell tomorrow morning just to survive tomorrow afternoon. They absorbed the panic. They bought what weaker hands could no longer hold financially or psychologically. And then what happened? Gold did exactly what the bedtime story promised, just not on retail's schedule. After the liquidation phase ended, gold went on a historic multi-year rally. It nearly tripled. So yes, the thesis was right. Gold was the play. But the people who showed up with the right idea and the wrong structure got carried out before the payoff arrived. That is the lesson. Being right on the asset is not enough. You also have to survive the path. The market does not hand out medals for being correct too early. It hands out margin calls. And that is the part people still do not understand today. They think the hard part is finding the right trade. It is not. The hard part is staying solvent, while the right trade behaves like it hates you personally. Fast forward to now. Look at the chart. Look at the chop. Look at the fake breakouts. Look at the violent wicks that slap both bulls and bears, like an exhausted parent losing patience in a supermarket aisle. That is not meaningless noise. That is the sorting machine. History does not repeat perfectly. It changes clothes. It upgrades the technology. It finds fresh victims. But the emotional structure is often the same. The centrifuge is spinning again. And right now, the market is not just deciding what gold is worth. It is deciding who gets to keep it. If you are over-leveraged, you are in danger. If every 15-minute candle changes your mood, you are in danger. If you keep telling yourself,
I'm investing, not trading,
while checking the chart 12 times before lunch, you are in danger. Because markets do not punish you for being stupid first. They punish you for being fragile. Do not confuse sideways price action with a dead thesis. Do not stare at price and ignore the liquidity war happening underneath it. And whatever you do not let the system squeeze you out of the right trade, just because you showed up with borrowed conviction and rented patience. Understand the game before it broke. But we need to go one level deeper, because if you stop here, you only understand half the trap. Yes, you understand how retail gets shaken out. You understand the margin calls. You understand the fake breakdowns, the emotional vomiting, and the charming little ritual where people buy gold for safety and then sell it for survival. That part matters, but it is still only half the story. Because once you know who is being forced to sell, the next question becomes much more uncomfortable. Who is buying? And more importantly, why? Look at the central banks. Look at sovereign wealth funds. Look at the institutions with balance sheets so large they do not think in quarters. They think in decades, sometimes in generations. Do you think they are buying gold because they want to catch a cute breakout on a Tuesday afternoon? Do you think they are hunched over a laptop, sweating through their shirt, drawing trend lines and whispering,
Come on, baby, just clear resistance.
No, they are not trading. They are repositioning for a different kind of world. Imagine you are sitting at a casino table. You are sweating over your cards. You are counting your plastic chips. You are arguing with the dealer about the rules. You are feeling very smart because you won 3 hands in a row. Meanwhile, the owners of the casino are doing something slightly more important. They are quietly unbolting the slot machines. They are emptying the vault. They are loading real cash into armored trucks out the back. Because they know something you do not. The building is scheduled for demolition tomorrow morning, and you are still sitting there bragging about your plastic chips. That is the global economy right now. Retail investors are still obsessed with the chips, the monthly candle, the breakout level, The ETF flows. The next CP I print. The next central bank speech. The next little sugar rush in price. They are trying to trade the room. The sovereign players are preparing for what happens after the room catches fire. And that distinction matters. Because most retail investors do not actually buy the thing itself. They buy a version of the thing. A claim on the thing. A promise about the thing. A ticker symbol connected to the thing. Something convenient, liquid, modern, and one step removed from the metal itself. Gold ETFs. Synthetic exposure. Derivatives. Digital claims. Nice clean wrappers for something ancient and heavy. And on the screen, it all looks the same. A ticker moves. Your app turns green. Your brain releases a tiny drop of hope. You tell yourself,
Great, I own gold.
maybe. Maybe you own exposure to gold. Maybe you own a claim tied to gold. Maybe you own a beautifully designed receipt for a cow you have never seen. In a barn you will never visit. Managed by people you have never met. That is not always the same thing as owning the cow. And that difference starts to matter a lot when the system gets stressed. Now look at what the central banks are buying. Not vibes. Not a chart pattern. Not gold-adjacent sentiment. Not a spreadsheet entry with a comforting name. Bars. Metal. Weight. Something you can touch, count, move, lock, and store on your own soil. That is a very different kind of decision. And it tells you something very important. The people closest to the plumbing of the monetary system are not behaving like people who trust paper promises forever. They are behaving like people who understand exactly how fragile those promises become once debt gets too large, politics gets too ugly, and currency printing gets too desperate. This is where most people still underestimate the endgame. They think the crisis is about volatility. It is not. Volatility is just the screaming on the surface. The deeper issue is debt. Too much debt. Debt that cannot be paid back honestly. Debt that can only be rolled, diluted, inflated away, or quietly suffocated through currency debasement. And the architects of the system know this better than anyone. Because they are the ones holding the blueprints. They know the machine is choking on obligations that no normal growth path can realistically absorb. They know the polite solution is gone. So what is left? Print. Debase. Extend the game. Push the pain into the currency and hope the public mistakes motion for stability. And if you are one of the people allowed to print the chips, what do you do before everyone else notices the table is rigged? You trade chips for things that are not chips. That is what gold becomes in this context. Not just an inflation hedge, not just a fear trade, a migration path out of trust-based money and into something with no counterparty, no earnings report, no CEO, and no government promise attached to it. That is why physical matters. Because in the final act of a sovereign debt supercycle, counterparty risk stops being a footnote and starts becoming the whole movie. A paper claim is still a claim, which is a polite financial way of saying, you may not own the thing. You may own permission to ask for the thing later, assuming the system is still in the mood to cooperate. And a claim is only as good as the structure backing it. If that structure is the same one being diluted, stressed, and stretched just to keep itself alive, then congratulations. Your protection may be denominated in the same fantasy it was supposed to protect you from. That is the escalation. That is the level beneath the level. The washing machine is not just there to take your money. It is there to take your position before the real repricing begins. To shake you out of the hard asset and leave you holding the soft promise. That is why the payoff here is not excitement. It is clarity. Stop worshiping noise. Stop confusing motion with meaning. Stop staring only at the chart while ignoring the vault. Watch what the people who print the money do with their own reserves. Watch what they choose to hold when trust starts thinning out. They are not panicking. They are accumulating. Quietly. Patiently. Mechanically. Using volatility to harvest what weak hands cannot keep. Using your fear, your leverage, and your shrinking time horizon to buy long-duration insurance at a discount. That is the final phase of the sovereign game. And this is the part most people never want to hear. The market may let you be right. It just may not let you stay comfortable while being right. That is why some people come into a macro shift with the correct thesis and still leave with nothing but screenshots, stress, and a new personality disorder. Because they focused on price, while bigger players focused on form. They cared about the candle. The sovereigns cared about custody. They cared about the breakout. The sovereigns cared about ownership. They cared about being right this week. The sovereigns cared about surviving the next regime. That is the difference. You can be the liquidity they absorb, or you can build a balance sheet that survives the centrifuge. That choice is still yours. But do not hand over your lifeboat for pennies just because the water got rough. Do not die holding the right thesis in the wrong structure. Stay solvent. Watch the vault and understand the endgame. Before it broke.